it's purely valuation. I mean, if you think about it, I think there are brilliant businesses in the world which benefit from us getting all locked up. And then there are brilliant businesses that benefit from us being allowed out again and the future beyond. The truth is the lockup is now going to be, I don't know, so we have no idea how long it's going to be, but hopefully not many years. And then so the majority of your few-year holding period will be benefited from the going out time. And these stocks are trading on our list of stocks that we like at sort of 30 to 40% discount to those stocks. And in the wider market, I think it's even more extreme. But the wider market does include stocks which are more speculative on both ends. But so for a 30 or 40% potential pickup, we thought just rotating some of the portfolio at this point. We don't know when we're going to suddenly be allowed out again, but it will come. And at that point, you can make 40% on top of owning high quality businesses. We think that's great.
Freddie, good morning. What I was struck by looking at the portfolio was just how far away you are from a higher rating in equities at this point. In fact, 26% in inflation linked, 11% cash, only 49% in equities. One, has that positioning changed much through September? And two, why such a high level of cash or cash equivalents?
I think the truth is, so this portfolio is designed to protect investors' wealth at the same time as generating returns. So it's not trying to shoot the lights out. It's trying to do sort of 7 or 8% a year. Having half of your portfolio in markets is still highly attractive. I think equities are the most attractive asset class out there at the moment, despite the strong rally, and particularly given the recent pullback. But I do think there's a lot of risk embedded in markets, interest rate risk in particular, inflation risk. You know, one of the greatest risks to stock markets is that somehow interest rates get back to 3% or whatever it might be, and you suddenly have an alternative risk-free rate. That will only happen if inflation comes through the system, as is broadly transpiring across all the central banks globally, and most clearly at the Fed. So to have something on your portfolio where you can offset some of that risk while taking a small amount of yield, and inflation-linked bonds have made 10% this year as well. So they've been a phenomenally good investment for us in their own right, and they'll also hedge that downside on the equity market better than I believe gold will. So that's why we have such a large position in those.